There have been big swings in the markets with shifting concerns about energy prices, inflation and interest rates. All of this, of course, adds risks for investors who have taken a hit already in their portfolios in the past 2 months. Well, Matt Sherwood is Perpetual's Head of Investment Strategy, Multi-Asset, and he joins me now. Matt, many thanks for your time as always. I just want to start with this because it's the volatility that really does concern investors right now, the whipsawing, not knowing exactly whether and how they can make firm commitments to equities right now.
Yeah, that's exactly right, Ross, and thanks for being on the show. And this really is the fog of war. There's no clear line of sight of how this battle in Ukraine actually ends. And markets at the moment are trying to allocate capital at a time when the US Fed is about to increase official interest rates. Inflation's about to spike higher. We have negative real wages growth, particularly in the US economy, and growth's going to slow this year. So it's a pretty horrendous backdrop for central bankers to be making policy deliberations. And the real challenge for investors is, despite this rally today, which I think will be a one-day rally, the situation overseas really has not changed particularly. And of course, we have to remember that if equity markets volatility increases, there won't be a lot of diversification from government bonds this time around, which are horrendously overvalued. So a very difficult backdrop indeed.
So what's the answer then, Matt? I mean, normally you'd be saying go to safe stocks, go to all those things, but it seems that everything's getting hammered by the market, mainly because, of course, as you raise interest rates around the world, it has a commensurate change and reduction in the price of anything that produces a yield, which includes shares or property, whatever it might be.
That's exactly correct. And I think this is the first stage, what we've been seeing recently, the three-stage sell down in equity markets. The first one's been driven by valuation declines as interest rates increases are factored in. I think that's fairly well advanced. I think in April we're going to get downgrades, particularly in US earnings growth on the back of weaker margins being factored in. By my analysis, margins are probably going to be off 10 or 15%, and the market's expecting them to be up a couple of percent. So I think that's going to be something that investors will have to stomach. And then finally, we're going to have the implementation of the US Fed's quantitative tightening program, and that's an issue for the second half of this year. So what we're doing at the moment in our funds is we have reduced the equity weight. We have more and more diversifiers in there, particularly option protection, and we have large cash holdings, so we can deploy money when we think that, and deploy it quickly when markets we think have hit levels which are overestimating the growth downside, but we're nowhere near that at the moment.
Isn't it funny, Matt, how just 12 months ago it was really a case where, the throttle was wide open on the Australian economy and on the recovery and indeed on the earnings of Australian businesses. And right now you've actually got almost a complete turnaround, even though inside many of those companies, given the fact that borders have opened, probably the earnings are continuing to increase. It's actually the valuations that have changed, not necessarily the earnings outlook.
That's exactly correct. And 12 months ago, we had this potent combination of vaccines, stimulus and reopening, which has seen earnings growth absolutely shoot higher. It was underpinned by sensational revenue growth. And even though costs grew significantly, they were just nowhere near the surge we had in revenue. But the trouble in the current environment is that we think revenue growth will slow down in line with the nominal economy. And at the same time, we have sustained cost pressures from both high commodity prices, but also very tight labour markets, and that combination is going to weigh on margins, and that to me is the Achilles heel of this equity market really in the next 3 months or so. Earnings growth will have to normalise, and I don't believe that's factored in at the moment.
And just very, very briefly, does the energy markets give any respite for investors right now? Is it something perhaps they just need to look at?
Look, I wouldn't at the moment, because I don't think anything's fundamentally changed. So yes, we had a 12% drop in global oil prices overnight. on an announcement by the UAE that they would have a chat to OPEC about maybe increasing production. The problem with that is that OPEC Plus has a very long-term strategic relationship with Russia. So they're not going to they're not going to boost supplies at all. And if if America wants to get away from Russian energy exports to both Europe and itself, you're going to have to find 4.5 million barrels of oil a day. If it's not coming from OPEC, it's going to be a very tight supplied oil market, and it's going to remain in triple figures for the vast bulk of this year. And that, to me, is going to be a hell of an inflation problem.
Yeah, Matt Sherwood from Perpetual. Always great to have you on the program. I appreciate your time very much.
Thanks for having me, Ross. All the best.